Start recording. Sorry about that delay. At the request of Berserker, I threw in a quick slide about the McClellan Oscillator as well. So let's go ahead and get started. So tonight's topic is going to be on technical indicators. Before I get into those indicators, I just want to go over an important point, and that point is that price is really king, and price is the most important thing on the chart. So there really is no holy grail indicator. Nothing's going to be 100% accurate or be able to catch every single price swing. Obviously, a lot of them are very useful when forecasting price. However, I've seen many people, look for that holy grail indicator, thinking, if they just find that one indicator, then they can focus their entire trading plan around that indicator and make tons of money. It simply doesn't exist. So if you're still looking for it, save yourself the effort, because it's not out there. And the reason for this is because all technical indicators are calculated using price data from previous period. So they're always going to be lagging price. They can't it's like driving, looking through the rear view mirror, driving backwards. You're not going to be able to forecast the future based on, past stuff with 100% accuracy. So overbought and oversold readings can be deceiving in strongly trending markets because the oscillator will remain embedded during the period of the trend, and many breakouts from the zone will prove to be false signals. So if you are relying on technical indicators to signal overbought and oversold periods, you might find yourself being on the wrong side of a trend at certain points, especially extremely strong trends. These situations, these oversold and overbought readings, can remain like that for long periods of time, much longer than you can remain solvent if you were trying to counter trend trade using those readings as signals. So please be aware of that. We've seen it tons of times, especially in the middle of a third wave. You'll see the RSI or the stochastics hit embedded readings where they get into the oversold area or overbought area and just stay there for extended periods of times. And even though the indicator is technically indicating that price is overbought or oversold, the trend just continues to go on and go on, often for what seems like, non-rational lengths of time. Somebody just asked, I can't stay long, do we get a recording? Yes, there will be a link probably posted tomorrow of this webinar. So if you can't make the whole thing, or if somebody else missed it, don't worry, it will be recorded and posted. So technical indicators, when used in conjunction with Elliott wave analysis, should really be used to support and not determine price patterns. The pattern itself is the most important thing, and you kind of confirm it or support it by using the technical indicators. For example, during standard impulsive waves, we're looking for the strongest technical readings during the wave 3 of 3. And during a corrective 3-wave retrace, we're looking for positive divergence on the C wave. However, while these situations occur almost the majority of the time, it's not always going to be the case. Lots of times you're going to have reversals that are non-positive or negative divergence. There are situations where maybe the wave 3 of 3 does not have the strongest technicals. Maybe the wave 5 of 3 has the strongest technicals because it was extended. So they're not 100% reliable in determining the pattern, but they can be used effectively to support the pattern. Indicators and oscillators should only be used as secondary evidence to confirm the trend. So again, price is really what's important. That's what you should be following, and the indicators are really there to kind of assist you in making forecasts or making trading decisions, and shouldn't be used on their own, and should not be relied upon, you know, with blind faith. With that said, indicators and oscillators are useful as confirmation of price behavior, and once the quirks are understood and the dependence upon them is secondary, you know, they can very successfully be added into a trading plan and help you make trading decisions such as entries and exits, or where to place stops, things like that. So let's go ahead and get into them. I'm going to start off with moving averages. Now, I personally don't use moving averages very often in my trading, so if anybody out there, you know, uses these consistently and successfully, please feel free to chime in. I know the love my iPad does, so. All right. A moving average is a constant period average, usually of prices, that is calculated for each successive chart period interval. So, for example, a 20-day moving average is going back the past 20 days, adding all the price bars from each day together, and then dividing that by 20 to get an average of them. And, you know, each successive period, it recalculates, and you come up with a moving average that is plotted on your chart. So the indication of a trending stock can be gauged by whether the stock price is above or below a moving average. The longer the moving average, the longer the trend the relationship represents. So if you're looking at a 15-day moving average and prices above it, or a 200-day moving average and prices above it, then the price trend is going to be longer when price is above the 200-day moving average than the 50-day moving average, most likely. So the longer the moving average, when price is above it, usually the longer the trend has been going on for. The most commonly used type of moving average is the simple moving average, commonly referred as the SMA, and it's constructed by adding a set of data and then dividing by the number of observations in the period being examined. So like I previously just said, a 20-day moving average is calculating the past 20-day prices, adding them together, and then dividing by 20. So moving averages can be used for trading strategies in 3 different ways. The first way is when you have what is called moving average crossover. So where a shorter moving average crosses over, can be either above or below. Above the longer one, it's often considered a buy signal, and likewise, it's considered a sell signal when a shorter moving average declines below a longer moving average. Moving averages can also represent levels of support, and this is most common with moving averages that a lot of people are watching or have on their charts, such as the 200-day, the 100, the 60, the 50, 20, or 10. Is that right, Love My iPad? Are those the most commonly watched ones? Maybe she left. 20, 50, 100, and 200. Okay. Thank you. Ricky G says the 35 or 34, 55, and 233 SMAs are awesome. So, I mean, a lot of people have personal preference in which ones they use. I know that Harry Boxer recently came on the site and said that he finds the 50-day moving average in terms of providing levels of support to be the most useful, and what he has found most of his institutional subscribers watch and follow. So I would really recommend, just trying some different moving average periods out on your chart. See which ones you find useful and which ones you don't, and, which ones are providing you with good signals. Yes, Love My iPad asks, can I say something before you leave the moving average slide? Of course. Go ahead and type it up, and I'll add it at the end. So you'll actually see the moving average plotted on your chart, and often when price reaches that, either above or below it, it can act as support or resistance, much like a trend line would. And often a lot of the moving averages will mimic a trend line, and certainly certain strong trends. So, the final way that you can use moving averages for a trading strategy is a deviation from the moving average is a measure of how much price has risen or fallen ahead of its usual central tendency. And a reversion towards the mean is often expected when price has deviated substantially from that moving average. So basically, you would be trading based on the assumption that there's going to be a reversion towards the mean in price, and when price kind of deviates substantially from that moving average, then it's going to eventually come back towards it. So you'll see, you'll see kind of parabolic moves away from moving averages. Obviously, the longer, the more reliable. And as it gets further and further and further away, the likelihood that it's going to reverse and come back towards that moving average increases. So here's Love My iPad's edition. She says, when day trading, she watches the 1 minute, the 5 minute charts for precision entries, and her rule of thumb is no longs below the simple moving average of the 50 period on the 5 minute, and no shorts above the 50 minute period simple moving average. 50 period, sorry, simple moving average on the 5 minute. So basically, she's using the first rule, this rule right here. Oops. That it can be an indication of the trend whether the stock price is above or below a moving average. So it can be good, or it can be useful for deciding whether or not you're going to position short or long, and determine whether or not you're actually trading with the trends based on whether or not price is above or below a certain moving average. So Love My iPad uses the 50 period, and she says if we're having a big trending day, you'll see price retracing to the SMA 20 or 50 period. If price doesn't break to the other side, use this retrace to enter in the direction of the trend on the 5 minute chart. So for example, today, I noticed that TCAT mentioned that once price broke down the 20 period SMA, he used that when we retraced to initiate a short position. And it actually lined up very close to where that fourth wave was on the chart, where I suggested that price would retrace to there and then reverse back down. So they can provide really good signals either to what the current trend is and whether or not you should be positioning yourself short or long, as well as providing support and resistance levels. So you'll often see confluences with fib pinball, is what Love My iPad just said. So yeah, more often than not, these moving averages, the most common ones, are going to be lining up with the same support and resistance levels that we're watching based on fib analysis. So, just another good tool to add to your toolbox when you're trading. So here's an example. This might not be the best example just because I picked a single chart for all the different things I'm going to be going over in this webinar. But here's a chart with a few simple moving averages placed on it. We have the 20 period. So this is a 30-minute chart of gold futures. We have the 20 period moving average in olive, the 50 in red, the 100 in blue, and the 200 in green. So as you can see, for example here, providing support for price in this trending upward move, the 50-day, you can see price came back and kind of bounced off of it a few times, and it proved similar support that a trend line would show. So, and you can also see as the shorter period crosses below the longer period here, when the 20 is crossing below the 50, it's kind of signaling that there is a reversal in trend and price is starting to move downwards. Obviously, it's not going to show you at the exact turning point because they're moving averages and lag price. But in terms of longer-term trends, especially, they can be very useful when used in that way. And you could also use them, if you were looking at this chart and looking for long entries, you'd say, I'm only going to go long when price is above the 50-period moving average, or I'm only going to short when it's below, and not look for any longs. So it's kind of an example on the chart of what moving averages look like, how they're plotted, and how you can use them for trading. James just asked, can you repeat what Love My iPad just said? She said, when day trading, I watch the 1-minute and 5-minute charts for precision entries. And as a rule of thumb, no longs below the simple moving average 50 period on the 5-minute, and no shorts above the simple moving average 50 period on the 5-minute. And when we're having a big trending day, you'll often see that price retracing to the 20 period or 50 period SMA. And if price doesn't break to the other side of those moving averages, you can use this retrace to enter in the direction of the trend. Is that clarified, James? Hopefully. Okay, next I'm going to move on to oscillators. Because oscillators are based on price data, they do not really add any new information to the analysis. They simply manipulate it, the same data in different ways. So different oscillators are just basically making different calculations based on price data. So unlike volume or different technical indicators such as advanced decline, they're not really adding anything in addition to price. They're just using price and different calculations of price to provide trading signals. So therefore, confirmation between different oscillators may be more redundant than informative. And for that reason, watching several different price oscillators calculated over the same period is not really necessary because by their nature, they're going to be providing roughly the same results. So if you find a specific oscillator that you like, that's all you really need is one oscillator on your chart that shows either good oversold or overbought conditions or good divergence. There are two types of oscillators, ones that are bounded and ones that are unbounded. Bounded oscillators swing back and forth within certain limits. So typically there's an upper and lower threshold level that signals either overbought or oversold conditions. An example of this is the RSI. And unbounded oscillators do not have predetermined limits and therefore must be observed over long periods of time to determine overbought or oversold levels. More commonly, they're used for indicating trend strength and divergences. So an example of that would be the MACD. So let's get into the MACD. The MACD stands for Moving Average Convergence Divergence. It is calculated using the difference between two exponential moving averages. This is traditionally going to be the 26-period exponential moving average, which is subtracted from a 12-period exponential moving average. So if you were looking at the input values when you're setting up this indicator, usually the default is going to be 26, 12, and then there is a signal line, which is usually going to be a 9-period moving average. So obviously you can adjust these based on your personal preference, but this is just the typical default setting. So these, like I just said, they can be adjusted for shorter or longer period analysis. I know that Love My iPad uses some different settings as well. So she has a MACD on her chart that's a little more sensitive to price oscillations, and one that is a little less sensitive and isn't going to give false signals as often. Love My iPad, can I ask quickly what the settings you use on your MACDs are? Okay, she's gonna look it up. So this calculation results in a value that's going to oscillate above and below a zero line threshold. A positive MACD, meaning above the zero line, indicates the average price during the past 12 price bars exceeds the average price over the past 26 price bars. So it indicates that price is trending upwards. And obviously, conversely, when it is below, then it's the opposite. So the signal line is also going to be plotted, and that's just simply an exponential moving average of the MACD line. So it's kind of like smoothing out the MACD line, and it's going to give you, you can either use it as a crossover, so when this signal line crosses over the MACD line, or you can use it just to avoid, the rough oscillations up and down that you might see in a MACD, because it provides a smoother line. So Love My iPad uses the classic, which is the 26-12-9 setting. And then her more sensitive MACD she uses is a 34-5-7. So her longer period EMA is going to be, or I should say the slow, I think is what it's called in the setting, is going to be 34. The fast is going to be 5, and then her signal line is going to be 7. And for a more pronounced histogram, she uses 3, 10, and 0. So the slow is going to be 10, the fast is going to be 3, and the signal line is going to be 0. And for an example of what those differences look like, just go ahead and check out one of her Apple charts that she posts, her Apple TA charts. So in addition to the MACD and the signal line, you'll typically see a histogram, which is the difference between the MACD and signal line, is going to be plotted as well. So the MACD is my personal favorite indicator for determining divergences and the strength of trends. It's probably the most commonly used indicator, and if you're going to pick a single indicator to have on your charts, my recommendation would be to use the MACD. And now we're going to look at examples of divergences using the MACD and how they signal, how they can signal turns in price. So first we have positive divergence. And positive divergence occurs when price makes a lower low while technicals are making a higher low. So here's our example of positive divergence. You can see at these two price extremes, price is making a lower low while the MACD is making a higher low. So basically the move down in price is not being confirmed by the MACD. And therefore it's signaling that the momentum of this move down is weakening, and there is a good chance that there is a reversal coming soon. So as you can see here, there was a nice bottom here based on this divergence, and price turned back up. Next we have negative divergence, and that is when price makes a higher high while technicals make a lower high. So here's our example of negative divergence, and this is on that same gold chart, gold futures chart that I showed of the moving averages. And as we can see here, price is making a higher high between these two price extremes, while it is not being confirmed by the MACD, and the MACD is making a lower high. And you can see it marked this stop pretty well. And it doesn't necessarily have to be a lower high or a higher high on the MACD. It can be an equal one as well. There just has to be some sort of divergence, obviously, between price and the MACD. Next, there's bullish hidden divergence, and that is when price makes a higher low while technicals are making a lower low. So here's our hidden bullish divergence, and we can see that price is making a higher low between these two price extremes, while the MACD is making a lower low. And that kind of signaled this nice move back up in price right here, which eventually led to another high. Then we have hidden bearish divergence, which is the opposite, which happens when price makes a lower high while technicals make a higher high. This specific example might not be the best. I tried to just find a chart that had all four of these on the same chart, but this is more like an equal high, I would say, on the MACD. But as you can see, price is making a lower high. A trick that Love My iPad recommends for remembering this is to think of the histogram in terms of mountains and valleys. When price makes a higher high and the MACD makes a lower mountain, it equals divergence. Another question by Alex is, where do you find the E-mini S&P 500 that Abby uses for tracking the market? If you do not have access to futures quotes through your broker and charting software, then you can use investing.com offers free charts and quotes of ES and other futures markets. So check that out. The only problem is that sometimes it's not very reliable, and often during busy days it's going to be delayed, is up to as much as 15 minutes or so. So I would really recommend, if you can, to get access to futures quotes through your broker, so you have your own chart that you're looking at that you can rely upon. Somebody else suggested that CME website and Globex also offers real-time quotes. You can find these. There are a few different sites that offer them. Go ahead and search around. It's been asked a few times on the site as well, so I know there have been a couple other options posted that you can check out. Next, we're going to get into the RSI, which stands for the Relative Strength Index, and it measures the strength of an issue against its history of price change by comparing up days to down days, or if you're not using it on a daily chart, up bars to down bars. So it operates under the assumption that overbought levels generally occur after the market has advanced for a disproportionate number of days, and that oversold levels generally follow a significant number of declining days. So in a sense, it kind of works in a similar way to the DMARC indicators that Gator Trader posts a lot on the site, which are very useful. And that is that when you have a disproportionate number of advancing or declining days, then it can sometimes signal that a reversal is coming. So the measured strength is relative to its own price history and not that of the market in general, which is sometimes a misconception that the RSI is relative to other stocks in the market, when it's just really measuring its own price history, not other price histories of other stocks. So the RSI is a bounded oscillator, and therefore provides overbought and oversold conditions, and can range from a low of 0, indicating no up days, to a high of 100. When the RSI is above 50, which is the midpoint of the bounded range, the underlying trend in price is usually upward. Conversely, it's downward when the RSI is below 50. And typically, an RSI reading above 70 indicates an overbought situation, and an RSI reading below 30 indicates an oversold condition. Now, depending on the market conditions, this isn't always going to be the case, so some people like to use different numbers or even adjust them based on whether you're seeing a strong trending market or a range-bound market. So usually you want to look for situations where price hits those levels about 5% of the time, and those are the levels we want to choose. So the default and typical levels are usually 70 and 30, above 70 indicating overbought, below 30 indicating oversold. However, some people use 80-20 or some variation of those numbers. A question that Mark asks is, when are MACD divergences most accurate as leading indicators in terms of Elliott wave theory? So how we use the MACD when looking at a standard impulsive wave, and maybe I can look for an example in a second. I should probably provided one. I know I've gone over this in previous webinars and pointed it out, but what you're looking for is the strongest technicals during your third wave. And the highest point in your technicals, the very, very strongest point, should be in your wave 3 of 3. So usually, typically, when you're going to start seeing divergence is going to be on the 5th wave of the 3rd wave. So that's when you'll first start seeing divergence, and then you'll usually see further divergence on the larger degree 5th wave. So the wave 3 of 3 should have the strongest technicals. After that point, you'll start seeing divergences as you start tracing out, the series of 4th and 5th waves to complete the standard impulse wave. In addition to that, typically you're going to see hidden bullish divergence. This is, of course, if the impulse wave is moving upwards. You're going to see hidden bullish divergence on the 4th wave. So although and this is comparison to the 2nd wave. So although the 4th wave is making a higher low than the wave 2 in the impulse, typically you'll see the technicals making a lower low. So you'll see hidden divergence in your 4th wave and further negative divergence in your 5th wave. Does that answer the question, Mark? And when we're looking at corrective waves, basically you're looking at the A wave having stronger technicals than your C wave. But again, these shouldn't be used to really determine the price structure, but kind of support or confirm it. So it's not always going to be the case. There are going to be instances where the pattern is not supported in this exact way by technicals, but that's still the pattern playing out. In terms of the RSI and stochastics, you're going to be looking for, during strong trending price moves, what's called embedded technicals. And that's basically when the price moves up into the overbought or oversold region and just stays there oscillating. Within that level, you'll see a few false breakdowns. Usually it's a sell. People use the RSI, and once it reaches an overbought, once it comes above 70 and then crosses back below 70, then that's when they'll use the RSI as a short signal. But during a really strong trend, you'll see, a strong trend upwards, you'll see RSI go above 70 and just oscillate and embed up in that oversold area and maybe break down 70 very briefly a few times, but immediately move back up. So those breakdowns can provide false signals and really hurt you if you're trying to counter trend trade a strong market. So that's why we use technicals to support our early wave counts, but we're not relying 100% on them because they're not always going to be reliable depending on market conditions. So when it supports an early wave count and you see some overbought conditions on a 5th wave as well as some divergences, then that can be a nice short signal. But you're going to see overbought signals in embedded stochastics or RSI during the middle of a 3rd wave, I'd say at least 80% of the time. So just be aware of that and don't necessarily try to counter trend trade based on those readings. So here's an example of overbought and oversold based on signals based on the RSI. So the same chart, I kind of just put vertical lines wherever the RSI went above 70 or below 30 and then crossed back into the middle of the range, providing either a sell or a buy signal. So you can kind of see how reliable they are. Again, this probably isn't the best example proper chart to use. I was just simply using the exact same chart that I used for the other examples. But you'll see we get a sell signal here. Doesn't catch the exact top, but if you did short right then you would have got that. Buy signal right here, obviously not at the exact bottom. Another buy signal here. Sell signal here. Right here is where you're going to see not necessarily embedded, but false signals. So it's telling you to short right here, it's telling you to short right here, and had you done that, you obviously would have gotten run over and stopped out. So during stronger trends, obviously please be aware of this and really use this indicator and the overbought and oversold levels as supportive evidence or confirming evidence rather than 100% accurate signals every time. And then I just threw this in at the end here because I know we talk about it on the site a few times and some people may not be familiar with it. But the McClellan Oscillator is another nice technical indicator that can be used. Here's an example of it using Avi's chart that he posts. It's an oscillator that is the difference between two exponential moving averages of advances minus declines. So it's measuring advances and declines across a certain exchange. I believe it's the NYSE for the McClellan. Somebody correct me if that's not right. Basically looking at how many stocks are advancing versus declining. And the two averages are an exponential equivalent to a 19-day and a 39-day moving average. And the extremes that signal either overbought or oversold occur at the 100 or 150 level or the negative 100 or negative 150 level. So the first overbought level in a McClellan oscillator often indicates the initial signal of an intermediate term stock market rise rather than a top. So once it goes above 100, it's usually not signaling overbought, it's signaling that there's a strong trend in progress. Subsequently, a rise that is accompanied by less breadth, momentum, and thus a lower peak in the oscillator is suspect. So in the topping zone, you can see divergence that will signal a possible top, not always going to be 100% accurate. So for example, right here, this peak right here probably provided a closer turning point than this one because there's divergence here. So price is probably making a higher high while there was a divergence in the McClellan oscillator. As you can see, it's not going to always be the case. Looks like there was some divergence here. I don't have a chart to compare to, but basically you're looking for kind of extreme readings, especially in the bottom zone. Bottom zone is almost never going to provide positive divergence signals. It's usually just when you see very extreme readings that you'll be close to a reversal. Next, what you're going to be looking for is whether it's above or below the signal line. Similar to the RSI, when it's above the signal line, which is at 0, then you're going to be in strong trending upward move. If you are below it, then you're going to be trending downwards most often. And you'll just see usually the oscillator oscillate above or below that depending on whether price is moving up or price is moving down. So I'm going to look at a few questions here. What time frame for the RSI do you find to give the least amount of false signals and is overall most reliable? So most people on the RSI are going to use a period of 14 is the most common look-back period. And I would generally say that if you increase that number, if you look back more bars, it's probably going to be more reliable, as well as the higher the time frame you're looking at, the more reliable it's going to be. you're going to see a bunch of oscillations between the overbought and oversold on smaller time frames. So while they might signal, small oscillations in price back and forth, they're not going to be huge turning points, really, if you're looking at a 5-minute chart. Somebody asked, where can you find the McClellan? I believe you can find it on his site, but it's going to be delayed. Stockcharts.com might have it, but it might be delayed unless you're a member. So yeah, it's going to provide. You can find it, I think, for free if you just search for it in Google. But it's going to be end of day stuff. You're not going to be able to look at it in the middle of a trading day. It'll post at the end of the day. But a lot of brokerages or platforms or whoever your data provider is, if you have a good data provider, then they should provide the McClellan Oscillator. With your RSI example with vertical bars, you seem to have drawn your bars from when they're moving from oversold or overbought into the middle area versus when breaking out from the middle area to the overbought and oversold regions. So yeah, that's typically how people use it as a signal to as a short or buy signal, is when it crosses that 70 or 30 threshold into overbought or oversold, and then crosses back down below it. Because during really strong price moves, you're going to see it go up above the threshold level at 70 or 30 into overbought or oversold, and just stay there for a while. So if you simply enter your short or long position right when that cross happens, then you're generally going to be early. If you wait until it crosses back below, you're going to be a little late, but at that point, hopefully you're on the right side of the trend. Somebody said that TOS has the McClellan Oscillator. I use RSI on the daily bar with 6-month chart for short-term signals. That's William's recommendation. So again, that was just a brief introduction to certain technical indicators, the most common two being the MACD and RSI, as well as moving averages, and how they can be used to augment a trading plan, and how they can be successful additions to the toolbox that you use for trading. Somebody asked, would you please talk about today's close in the ES, and you still think there will be a bounce? I do think there will be bounce. I haven't looked at the ES chart since it closed. I mean, I saw briefly on the board that the price was still falling. So what you're going to want to be looking for when determining whether or not a bounce is likely is there going to be positive divergence on the MACD? Is the RSI in an oversold area and possibly crossing back in to the middle range? And is it at fib support? But this decline today should have been either a C wave or a third wave under the yellow count, which means that a fourth wave bounce as well as a fifth wave reaching one more low on positive divergence should be seen. I mean, this is going based off, what is generally seen in impulsive waves in the market. So obviously the low today wasn't made on positive divergence, so it's signaling that was the middle of the third wave, as well as the price structure. It really seems like we only have 3 waves so far. So to end this webinar, let's go ahead and do Adult Swim. And I figured I would do a corrective pattern this time rather than an impulsive wave. So the chart we're looking at here is Google, and this is right after the rise during the first half of May, which coincided with our 5th wave advance in the ES. And we have come to a potential turning point. You can see here that we have some nice negative divergence forming on the MACD. The rate of change shows that price is losing momentum as well as showing some divergence as well. Divergence obviously between this price high here and these two price highs. So what we're going to be watching for is an initial 5 waves down and then a retrace back up to enter a short position. So what we have here, it looks like, is a wave 1, two, then a wave 1, 2, 3, 4, and this should be our 5th wave. Oh, hold on. Just typing spaces. So this should be our 3rd wave, our 4th wave, and then we have a strong 4th wave or 5th wave coming down here. We get a nice retrace back up. So we're going to be watching for our common Fibonacci retrace levels for wave 2. So because this is supposedly we're assuming it's going to be a corrective decline, we're going to label this either a 1 or an A wave. Since at this point we're not sure. And then we're looking for our bounce to short as either wave 2 or wave B. And as you can see, this is one of those instances where price or the pattern is not necessarily confirmed 100% by the technicals, because this 5th wave shows the strongest technicals. There is no, actually no, not on the histogram either. So like I said, it's not going to be 100% fail-proof and should not determine the price pattern, but should be used to confirm it or support it instead. So it looks like here we have an A wave, a B wave, and this looks like a wave 1, 2, 3. Hopefully this is a wave 4, and then a 5th wave into the 50% or 61.8% retrace. Let me just put that in there. So if you can see here, hopefully this is a wave 1, 2, 3, 4, and 5 for us to enter our short position. If it breaks down below this 904.48 level, which is the top of wave 1 of the C wave, then either we're dealing with a diagonal or the C wave's already complete. So let's kind of watch how this develops. It looks like it's breaking down. It came really close to the 0.50, so if you're aggressive, you can enter a short position at this point with a stop above this high. Or if you want to give a little more room, maybe above the 0.50 retrace or the 0.618 retrace. So it's turning back up a little bit. It's possible we're dealing with an ending diagonal here, which is going to retrace up, expanding ending diagonal to give us that 5th wave in C. So if you did enter short and you saw this, depending on how much room you wanted to give it, and depending on your position size, which would hopefully allow you to give it enough room to retrace to the 5-0 or 618, you could allow it to do so. So it does look like the C wave is complete. We're breaking down in a big way here. And now that we have a wave 1 and wave 1 or A and wave 2 or B in place, then we can add our next fib set to give us targets as we move down. So if it's C wave, then we're typically going to be looking for price to stop at the 1.0 extension. This is the most common Fibonacci relationship between an A wave and a C wave. However, if it's a third wave, then we could be extending all the way down to the 1618, which is going to be the most common target for A wave 3. So to help us kind of determine which one is at play here, we can watch these fibs that are closer by to signal if maybe we're getting a wave 1 and 2 of what would be a third wave, and whether it would be more proportional for that wave 1 and 2 to reach the 1.0 or the 1618. So we're short. Our stop is just above this high here, where the C wave ended, and we're just going to follow down price. So it looks like we got stopped out on that trade about, let's see, if we entered right here, we lost about 3 points, and a larger A, B, and C is probably at play. So if you were watching this on a closer time frame, you could have moved your stop down to the smaller 1 and 2 right here. You know, I'm just running through this really quickly, so obviously wasn't looking that closely. But we had kind of a false breakdown here, which looked seemingly a strong move that reversed back up. So now that we have a larger A and B in place, let's go ahead and see where our C wave might stop. So we have some fib confluence between the 1382 extension and the 764 retracement. Both of those fibs are lining up right on top of each other. However, the 618 and the 1.0 are fairly close together, so if you're looking for a re-entry, that's probably going to be your place to do so. And either layer in at that point and add more if it continues higher, or you know, just allow yourself enough room. So either the B wave's not complete or that C wave truncated at the 764 and the 0.50 retracement. Looking at the technicals here, you can see some divergence between our C wave and our A wave. So it is supported by the technicals that perhaps our C wave truncated and we are now heading down. So now that we have a wave 1 and a possible wave 2 in place, we can enter short again with a stop just above this high. So this would be our wave 1 and 2 of either a C wave or a third wave, and we're going to place our stop just above that wave 2 high. Let me move our fibs up and see how it progresses. So now we're getting a nice breakdown. We break down below this shelf support right here. Still going to keep our stop just above this high and hopefully follow it down. This looks like a smaller degree, wave 1 and 2, so you could probably move your stop to break even at this point. If it's a C wave, which so far is not being confirmed by technicals, as you can see there's no positive divergence on the rate of change. It looks like there could be if price reversed immediately right here, strongly back up on the MACD. But we can kind of watch how this develops and either take partial profits if it does come down to the 1.0, or just move our stop down and maybe follow it down further to see if this is the third wave. So we're coming into the 1.0. It just, comes a few cents shy of it, so maybe right at that level right there, we would take some partial profits on our short. Then you have a nice gap down after that, which obviously is not on any positive divergence and should be signaling that this is more likely a third wave. So there's no positive divergence really on this drop here because it was a large size gap down. But again, you can't rely 100% on the technicals. So if this is a third wave, it could very well be that this is the fifth wave of a third, and we are going to stop at the 618. But at this point, we can move our stop down to just above this previous wave 4 top right here, which also coincides with our 618 retracement level, which is generally what we watch for price to reverse back above during a suspected impulse wave to kind of invalidate its chances. So our stop is now going to be moved down to, let's say, 895.5, and if you didn't take profits at all on this spike down day, then you're going to definitely want to take more profits, if not exit the whole position at the 618 extension. So we get kind of a half gap fill here. Remember that gaps don't necessarily always get filled completely. Some get filled halfway, and that's enough to satisfy as a gap fill. Coming back up a little more to, looks like, fill all of the gap. But our first area of resistance is going to be where the gap started, as well as this 1.0 extension here. So let's see if it acts as resistance or not. So price is spiking above it. Again, if you wanted to take profits or leave your stop here, that's obviously personal preference. If you do leave your stop here, you're still going to be profitable in the trade, and you should have netted more points to the downside than you lost on that stop out on the upside. It's looking like this is, if we are in a third wave, that this is definitely the fourth wave retrace here. So we're going to use our retracement fibs here. It's already past the 382, which would be our first signal that this is not a wave 4 and that this was actually a C wave. Because remember, during a larger 3-wave A wave, a lot of times you are going to see the C wave, which looks like a third wave and kind of acts like a third wave. It's not on any positive divergence, and it's going to be your lowest point in your technicals. So sometimes it's hard to distinguish between the two. That's why I like taking profits as price moves down, partial profits, and just moving your stop down. So the loosest stop you should have at this point is obviously the stop I mentioned earlier, 89.5. Price, if this, you see how this could be a wave 1, 2, 3, and it's coming back and invalidating that wave 1 level, I would definitely be moving my stop down to right here, above this high. Because it looks like we had a possible 5-wave structure up, and if this is a C wave, then followed by a 3-wave retrace, then the typical minimum extension is going to be above our stop anyway, so might as well just take the rest of the profits that we have and put our stop just above this high now. So we didn't get stopped out, and we kept ourselves in the trade while still protecting even more profits by moving our stop down. And that means we had a truncated top here, because this really only looks like 3 waves down. Either that, or this is a B wave, in which case this is going to be an ABC for an A wave, a B wave retrace, and this is a C wave down. So in both cases, whether this is going to be a 5th wave down and this was a 4th wave, right here, I'm going to be following with the stop really closely on this decline here. It's hard really to say, exactly what level, how much room I'm going to give it, because, I'm looking at a 10-minute rather than a 1-minute chart or something and really scrutinizing at the smaller pattern. But we might not actually reach our 1618, and if we don't, I want to take advantage of this second chance I got to grab profits here. So, I might just split the difference and just follow down with retracement fibs and of this move, and just set my stop right above the 50% retrace. And as it continues to move down, I'll just follow the fibs down, and as the 50% moves down, I'll just move my stop along with it. So it looks like we're going to get a chance to actually hit the 618, which is where I'm going to be taking all of my profits for the rest of the trade. Looks like it spikes just below, and I would be out of the trade at this point. So with an entry right here, and even getting stopped out on this this C wave rise here, I mean, depending on how much room you gave it, if you gave it enough room, you wouldn't even have been stopped out on that first attempt at the trade. But even if you were, you still caught a much, much larger amount of points down than what you got stopped out of. So still a very nice trade. There's only 3 waves here. So if this is a 5th wave, then we're definitely looking at a 4th wave retrace, then one more drop, which could come down to a lower fib, such as the 2.0 or the 1764. But because we're starting to develop some nice positive divergence, as you can see here, price is making a lower low, but technicals are not confirming that. Technicals are look like they're going to make a higher low here, unless just price continues to decline, with a lot of momentum taking out this divergence. If you wanted to stay in the trade, you could obviously continue with that plan of just following down with a stop. But I typically like to take profits at standard target fibs, and if I miss some of the move, so be it. I don't have to catch 100% of the move. Looks like price is kind of consolidating here in a potential fourth wave, which could set up another drop. Because, typically when you see a strong trending price move and then a consolidation period, it's usually setting up one more decline, at least. So this could be our fourth and fifth wave within this larger degree fifth wave. However, price is turning back up, and my personal trading strategy, I would already be out of the trade. I don't really care if it comes down a little further. If it does, then I'm just looking for another entry at a later point. But obviously, if we don't get a fifth wave down and price comes back up above this 880.75 level, then that's an invalidation of the five-wave pattern in this fifth wave, and we only are left with three waves, which would make it a B wave. So let's see what happens. Almost looks like a triangle or a smushy, whatever you want to call it. Somebody said this is showing hidden bullish divergence right now, right? Well, no, this is showing positive divergence because price is making a lower low while the technicals are making a higher low. However, if this MACD comes back above this high right here that was made on this price swing, then that would be hidden bearish divergence. So, it's possible there's a fifth wave there. That was kind of truncated in fashion. That could be an ending diagonal. You're kind of splitting straws when looking at it. It would obviously be truncated because it didn't come down, to a standard target level. But we had a nice gap up right after that. So, in the case that this is a B wave rather than the fifth wave, let's just check out what sort of fib relationship we might be looking at. So I'm going to get rid of some of these other fibs. So this would be the 1.0 extension right here. Again, it's the same resistance level we saw earlier, which would make a running flat if this is a C wave. So I'm just going to put that possibility in the chart. So this point right here would actually be the ending point of the A wave. Oops. And it would be an expanded or running flat where B wave is making a lower low, and then we're getting a retrace in a C wave back up. Somebody said, I thought this was supposed to start at 9 p.m. Central Time. It was actually Eastern Time, unfortunately, Toby, but not to worry. I'm recording it. It'll be posted on the site tomorrow, so you'll be able to go back and watch it again. So we have a nice strong move here, and I'm pretty happy that I got out of my short position at the 1618 target. If that was a 5-wave move down, then let's throw some retracement fibs on there and see what we get. Put the 382 on there as well. So you can see the price just tagged the 382 at the exact same level as this previous price high right here. If for some reason you were lucky enough to get long and trade this, this would be a good point to take at least some partial profit, because there's some nice resistance right at this level right here. If this is a C wave of this blue B possibility, then the 1382 is a pretty common extension to be watching. So again, if you somehow caught this long, that would be another good point to take partial profit. And we can see price starting to turn back down. Since we don't have solid wave 1 and 2, so it's hard to be sure if this is a 4th wave or if price is now turning back down to head to lower levels under this blue count. If it was the 5-wave structure of the downside, and this was a wave 1, 2, 3, 4, and 5, completing right here, then I would think that this is only an A wave. But given the structure of it and the lack of clarity of 5 waves in this decline right here, then I might actually favor this blue A and B wave count. So if I was really aggressive, it looks like we have a leading diagonal possibility here. 1, 2, 3, 4, 5. So if we get a retrace back up, I might attempt another short with stop above this high. So it's looking more like a standard impulse wave rather than that leading diagonal possibility with a series of 1s and 2s. So wave 1, 2. This will be a smaller degree, wave 1 and 2. Possibly 3 and 4 of wave 3 here. Then a nice gap down again. So it looks like we're confirming the blue count at this point, since there was really only one wave up here. So it's kind of hard to view that as the entire correction by itself. So it's more likely that this was the C wave of a expanding flat. So I'm going to go ahead and change this to the blue count, meaning that this high was an A wave, this is a B wave retracement, and then we have C wave on this gap up. Unfortunately, because of the lack of clarity on that, I wasn't able to confidently enter a short position right here. So far I've missed this move, but hopefully it will provide us with another opportunity to enter. So now I'm going to throw some fibs on the chart again. If this is a C wave, then we're looking for a one-to-one relationship between the A wave and the C wave. So our target is going to be this 84.5 level down here. So again, it's because, I mean, it looks like really either this is a series of 1s and 2s, 1, 2, 1, 2, 3, 4, and then an extended fifth wave, or this is an A, B, and then 1, 2, 3, 4, 5 of C wave. And this large degree C wave is going to be an ending diagonal. So what I'm watching here is whether we get another set of fourth and fifth waves or not. So this would have to be the fourth wave bounce, and then another low made to make a fifth wave, for it to be a 5-wave structure to the downside. Otherwise, we only really have 3 waves here, which would be this 3-wave A wave, B, C. Oops, I didn't mislabel these. So again, price has to come down again, make new low in 5 waves for it to be a 5-wave structure. And it's starting to get a little bit disproportional to be a 4th wave. So let's just draw a trend line here between these declining tops, just to show that we have resistance at this level. If this is an ABC of an ending diagonal, we'll throw some fib resistance on there as well. Looks like it's coming into the 5-0 retracement as well as this trend line resistance in what could be an A wave, a B wave, 1, 2. This would be 5 waves in A wave 3, 4, and maybe 5. So you can see it hits that resistance, struggles there. I mean, I would really like to see one more wave up in the C wave that holds above this support right here. This would be the top of wave 1 in that C wave, if you can see that. B, maybe C up to there. And if we are looking at an ending diagonal, then this would be the wave 1, 2, of that ending diagonal. So it looks like it's going to come back down and break through this level. If you were really aggressive, then you could take that as a short with a stop above this high right here. So aggressive traders might have been stopped into a short. They would place the stop on that trade above this high. And because this really looks like only 3 waves down, be aware that you are most likely playing an ending diagonal, and therefore it's not necessarily going to be an easy short trade to take. But even ending diagonals tend to play fib pinball. So there was a big spike up there. Again, if you took that short, then, I mean, you'd be at a loss here at this point with your stop not too far away. Price just keeps attacking this trend line here, so it looks like it wants to break above it. You know, if I had shorted, which taking this short is not my personal style, I probably wouldn't have, then I would probably be feeling pretty uncomfortable at this point. and would either hedge it if it wasn't hedged already, or maybe move my stop down to this high. So price is starting to break above the trend line resistance, comes back below it, but testing it again, coming back above. Now it's riding on top of it. It looks like this is going to take off to me. You have some coiling action in the MACD. Really does not look impulsive to the downside. It looks like price is going to come up here. You know, but it's possible it just continues to ride down this trend line. So if you wanted to just follow down and keep a tight stop on that short you took, if you did take it, you know, that would not be a bad idea. Looks like there's a spike down from that point. So if you did stay in it, then you have a nice A wave, a B wave triangle, A, B, C, D, E, and this would be the C wave. So I would definitely, I mean, the most common extension for this in the ending diagonal, if I were to pick a target, my target would definitely be that 764. However, being in an ending diagonal and trading that, because it's so treacherous, I would not give it much room. My stop would most definitely be at least break even at this point, if not a lot lower. You know, I'm going to be trying to protect at least some profit, because it hit this 618, it's bouncing back up in this point. I mean, really, this should be a fourth wave of this C wave here to come down to the 764. But it doesn't necessarily have to do so. So yeah, it does look like we got that fourth and fifth wave of our C wave. This is where I'd be taking profits. It's right here on this decline. If it doesn't hit that 764, my stop is not very far behind it. Looks like it came just shy of that 764. Oh, came back up, tagged it, and is actually moving lower to the trend line support. So if you did take it at 764, didn't catch the exact bottom, absolutely nothing wrong with that. But from the looks of it, oops, that's not what I wanted to do. I don't even need these fibs anymore. This is what we are looking at for our ending diagonal. So based on the trend line and fib support, my target for this fourth wave is going to be this 382 extension here. So you can see how in ending diagonals, when you're looking for support and resistance levels in them, what you're basically doing is watching where fibs and trend lines are matching up. And you can also use them for where they cross and line up to kind of give timing, although it's not going to be the most accurate thing in terms of timing. Sometimes it works. So we came up and hit that 382. Didn't hit the trend line. If you're trying to play this fifth wave in an ending diagonal, which I really wouldn't recommend doing because you know how violent price reversals out of ending diagonals can be, you might have taken your short right there at this price high, maybe with a stop above this B wave top. Spiking just above it, hitting the trend line. Looks like it did provide resistance and is tracing out what looks to be like a triangle. You can see that here. Again, I'm just watching price at this point personally based on my own trading style, not trying to trade this. What I'm looking for is a fifth wave down to complete the ascending diagonal to go long rather than trying to short at this point. So sometimes you do have to adjust your trend lines. An ending diagonal based on how price is behaving. So we have an A, B, C, D, E. This should be the start of our decline in our fifth wave of C wave. Let's see if it is. Yep. Again, it's going to be a three-wave move. This is likely the A, the B, and then the C wave. You can see here the amount of positive divergence has been building. Our A wave low still has the lowest point in the technicals. This is what you want to see on a C wave setup. Is the C wave is developing nice positive divergence. Just label this for reference. A, B, C, D, E. Nice complete triangle for the fourth wave. We had a spike that came just shy of the 1.0 extension. And this actually could be complete here. Aggressive traders could go long here with a stop just below the 1.0. MACD is starting to turn back up. Looks like we're getting a nice rise out of it. This is looking impulsive to the upside. If you hadn't already gone long, maybe you can get long with a break above this trend line and this E wave top right here. Looks like we have a wave 1 and 2. This is working on a third wave. Oops. Oh, I should have gone back one. But on that break, that's maybe your entry to get long. Now on this Google chart, my personal way of trading it was that I got long on the break of this trend line here. So right before close on this day, I bought a spread for July. And then the next day we had a nice, very nice rise out of it, which looks like top of a third wave here, and then maybe a fifth wave coming at this point. So as you can see, coming out of an ending diagonal, they can make for great trades because they often have very strong price reversals that come back up to where the ending diagonal started, which is this level right here around the 890 level. But this is looking like a fifth wave here. So again, protect profits. And if you've been following Google at all, this would be a fourth and fifth wave of the fifth, coming back up to where the ending diagonal, well, very close to where it started. I would likely be taking profits, at least partial at this point. So yeah, it looks like it tagged just about where that ending diagonal started. Not a bad place to take profits on this trade. I'm just going to go ahead and fill it in because I'm sure most of you are familiar with Google and where it is at this point. So that is and now we're updated to today. This is kind of where we stand on Google at this point. The possibility that we were originally looking at was that this was the bottom of a fourth wave or B wave, and this is when we had more hopes of the green count in the indices. However, if you see the technicals here, you see that we have much stronger technicals on this high than this. You can see there is some strong negative divergence developing here. You see that the technicals are much stronger over here during this rise than during this one. That to me is a signal that this is not a third wave, and instead this is an ABC. So that's why if you look at my recent Google charts, you'll notice that I have this labeled as an A, a B, 1, 2, 3, 4. We should get a fifth wave still, but it's possible that it's already complete, and this is a C wave top. So at this point, I am not long Google anymore. I exited my Google trade actually yesterday when I was trying to reduce my exposure going into the FOMC day. So got out of Google near the close of yesterday. So I'm flat Google right now and really not interested trading Google unless I see some sort of ABC decline here on positive divergence. Then I might try long again. Or I see a 5-wave structure down, 3-wave retrace back up, then I might try short. So before I end the webinar, are there any questions that people might have? Looks like somebody asked, when you say you bought, are you talking about options or actual underlying Google stock? On this particular trade, I was playing options using July calls that I turned into a spread, kind of balancing in between the ratio between the long and short side, depending on where we were in the count. Obviously hedged every night, because that's generally what I do. And, you know, when we got into support or resistance levels, or when technicals started showing positive or negative divergence, then that's when I would put the hedge back on. Somebody often not clear to me if people in the trading room are trading options mostly or underlying equities. Honestly, it depends on your personal preference. Whenever you want to choose to trade, whatever you're comfortable with, you can do either or. Obviously, options are going to give you more leverage. However, they're a lot more difficult to manage as a trade and a lot more sensitive to price swings. So it's easier to get an entire profit of a trade wiped out by a big gap on an option than it is in stock. So just something to keep in mind. Obviously, before putting a bunch of money into options, paper trade them, get comfortable with some of the different strategies, such as spreads, and even just trading basic straight calls or puts. Options being the case, how do you decide how far out to buy? I chose July because even though it seems like this was going to happen in June, I mean, look, I chose if I remember correctly, it's July 19th was the expiration date, is the next monthly expiration date. Clearly, that's giving me more than enough time. One, because you always want to give yourself more time than you're expecting, because timing the markets is extremely difficult, and as a general rule of thumb, it's going to take longer than you're expecting. So your conservative estimate, go out 1 month further than that. Number two, if you're playing options, the closer you are to expiration, the faster the premium is going to get sucked out based on time decay. So as you get closer to expiration, the time decay is going to increase. which is the theta Greek of the option. I love my iPad just said I am, so I'm waiting for what she's about to correct me on. And if you're not comfortable with some of the strategies, then... Oh, Monica always likes trading spreads. I'm just saying, if somebody's just starting out in options, spreads might be, a little bit harder, and they could try straight calls or puts instead. But obviously use less money when doing so. Somebody asked, I'm sorry I missed the first part. What time frame do you prefer to use for your charts? I mean, it depends. Typically, I'm using a 3-minute for the smallest time frame, a 15-minute for my intermediate, and a 60 or 144 or 200-minute, depending on the chart and kind of what I'm looking at, the pattern I'm looking at for a longer time frame. And then daily charts, obviously, as well. And weekly ones if you're looking for the much, much larger count and pattern. But again, just personal preference. Figure out what you like. Figure out what time frames give you the best signals on your indicators. And you can also play around with the parameters of the indicators, such as the look-back period or for the MACD, the moving average periods. So your call on VIX today would be good for options in July, as you expect the VIX to target in a few weeks. I personally don't remember making a VIX call since I don't track VIX. Maybe I don't think I said anything about VIX today. I know that Cal put out a chart, but if you are in VIX looking to play some upside, and either in a call spread or in straight calls, then yes, at least July. I would not be playing June weeklies at this point, and much safer would be August as your strike month, expiration month. Any other questions? Well, if there are no other questions, oh, looks like we got one. Okay. How are you thinking we're handling this extension ES Wave 1? Again, I haven't looked at a chart since close, so I'm not really sure what the pattern looks like or where price is at. But, I mean, I'm in a spread, a put spread in SPY right now that's expiring in August. So, and that's the only short position I have at the moment. I picked up a little bit of VIX shares after the crush before the FOMC announcement, but it's a pretty insignificant position. So basically what I did was try to flatten my book as much as possible to remove the delta from my portfolio going into today, and waited for confirmation either way. Now that it looks like we're in Wave 3, I'm going to wait for this Wave 1 to complete, a Wave 2 retrace, and then I'm going to start shorting in a more serious way. So I don't have any, strong positioning right now in the market. Any other questions? Somebody suggests the best way to construct a bear spread is to buy the put first and then sell the lower strike. That is one strategy that you can use and works well if you are doing it in the middle of a confirmed third wave. However, there are instances when you try to do that and try to get a better price on your spread by staggering when you're buying them, and it ends up going against you, and you either price reverses that day, or you wake up the next day to find out that you should have hedged your position before close. So not always the best strategy, I would say. I mean, I personally, usually, sometimes I do it that way, but usually I'm buying both legs at the same time and then just changing the balance as the trade, throughout the life of the trade, depending on how much leverage I want or what I'm trying to achieve with Greeks. So yeah, and Love My iPad just made a good point. It really depends on you knowing your Greeks or not. And you have to pay particular attention to theta and vega. So delta is not the only important Greek. Theta and vega are also very important. My concern is both can be done together. Yeah, you should be able to construct the spread in your trading platform and then execute them as one single trade order. So it'll come up with a price of the spread together, both the short and long side, and you should be able to put a bid in for that spread and execute both those orders at the same time. Whatever trading platform you're using should be able to do that, and if not, I might suggest getting a new broker. Other questions? I mean, I can't offer specific advice because I'm not sure what platform you use, and unless it's Interactive Brokers, I'm not familiar with it. So again, I wouldn't know how. But I'm sure if you just search on Google, vertical spreads, and then type in your platform or broker, then you'll find an explanation. And of course, you can always call them up and ask the support staff how to do it. Other questions? If not, then I'm going to end the webinar here, and I will see you guys all tomorrow in the trading room. And hopefully we can get a nice bounce overnight and set up another short for the fifth wave tomorrow. Good luck with your trading, and I will see everyone tomorrow. Good night.